So let's move to the, the next slide here to take a look at how this is used. So here's a pension plan forecasting its funding ratio. And the funding ratio is a pension plan's assets compared to its liabilities. So liabilities are the present value of the future pension benefits that the plan is to pay out. And of course the assets are simply what they have today. And if they're equal, that means you would expect, based on your analysis, that you'd be able to pay the benefits that have been promised. And of course here we see that San Jose has roughly a 60% funding ratio. So for every dollar in money that it should have, it has 60 cents. You'd like to have more. So there is certainly a risk to any city or any entity that has a pension plan that's underfunded that it could run out of money and ultimately result in bankruptcy. So, and that's just not something you want to have. And at the time that I'm making this, Detroit, the city of Detroit, Michigan, has just declared bankruptcy. And one of the largest liabilities is their pension plan. So it'll be interesting to see how that all works out. And it's very unfortunate for everyone involved. One of the problems that you have is if things turn down, you won't meet your requirements, and that's essentially what this shows you. The line between the red box and the yellow box is the 50-50 probability that the outcome would be there. So a large loss, of course, could be, this is a percentage of payroll, contributions percentage of payroll, which everyone contributes to the pension plan, both the employees and the city itself. So the plan looked at several alternative mixes. Here they're labeled A, B, C, and D. And the real difference here, the primary difference here, is that absolute return strategies are 25% in mix C, and they vary across the spectrum here. But what we really wanted to see was if we did absolute return strategies, hedge funds basically, how would that affect the probability of meeting our obligations? Here are the capital market assumptions that were inputs. So what you expected in terms of return and volatility, as well as the correlation between the asset categories. And this is the detail behind that. If you go to the Harvard case, you'll see their capital market assumptions in the case that they used as inputs to their model. So here are the probabilities for the different asset mixes. You'll see that the highest allocation in mix C to hedge funds results in the lowest, the best worst case. So if you had a severe market downturn, that would be the mix that would perform the best. Now you end up with essentially the same expected value, but in a downturn scenario, you are less vulnerable. Of course, in an upturn, you don't have the upside, but it's really the downturn that is most concerning because that could be a financial disaster. So this discusses the different mixes, and let's see. So ultimately, the San Jose pension plan, there are two pension plans, but the one that I'm most involved with chose to allocate 25% to absolute return, which are hedge funds, and that process is still ongoing now in terms of deploying money into the hedge funds. It's roughly $500 million that will be deployed there. So on a monthly or quarterly basis, progress is tracked. Here's an example of the current market value, the target, and then the target range. So you can see that the actual allocation is going to vary because the market changes every day and the value of the assets change every day. Here's a performance attribution versus the benchmark. So a portfolio that had the exact allocation of the target portfolio is compared to the actual portfolio. And there are two ways that it can differ. The first is you could have an allocation to equities, for example, that's different than your target. Your target's 50, you've got 55. So if the market goes up, you do a lot better because you just have more equities. The other way it can differ is you might pick better stocks. And so if you have 55% allocation to equities, your target is 50, if you outperform, there are two ways it could be a result of that. The market could have just gone up and you had more than your target, or you could have picked better stocks. So this analysis divides in the outperformance, underperformance into the two categories. Did you own more or less than your target? And then did what you own do better or worse than its benchmark? And this just explains what I just said. Fixed income is analyzed in a table such as this, which really isn't very different from an equity analysis. Equities, of course, are of many types. You can have domestic, international. You can have privately owned equities. These are companies that do not trade on exchanges, but are privately owned businesses, and real estate debt as well. And in some categories, you may just not want to hire a manager. You may feel like it's very difficult to pick large cap stocks in the U.S. And outperform a benchmark. You might just go ahead and buy an index because the fees are very low there, and if someone isn't going to beat the index anyway, you might as well not pay much for that effort. You can look at prior periods to say, this is a very bad time, like calendar year 2008, or some other period when interest rates spiked in 1994, which would be very damaging to a bond portfolio. So you can run your current asset allocation through that scenario and say how would our portfolio that we have now compare to that based on the assumptions that we have for performance. That's what this analysis shows. And this is another stress test analysis. And that's the last page of this presentation. So I hope this was helpful for you. I look forward to seeing your comments online.